Good morning, everybody.
Morning, Sharath.
Raju, nice to see you guys on a Saturday morning. I'd like to know what are your expectations, Sharath? You just became with another webinar. We had something on fixed income last week, and how is this different? While we are giving about a couple of minutes for the rest of the folks to join in, anyone like to pitch in terms of how these two products are different? We had last week we had a product from Lane Dane, and today we have a product from Liquibonds. Any guesses, any idea in terms of how these two products are different? Zubin?
I think this
I'm
is
sure you've done your
secured.
research here. Come on.
This is a secured investment, and the P2P lending was uh,
Oh, both are regulated.
both are regulated. Okay.
Okay. For those of you who are not aware of it, I'll make this very distinction very clear. P2P is a different asset class, and bonds is a different asset class. Now, while both of them come under fixed income, they are regulated by two different. No, they are regulated. They are regulated under different platforms. P2P is where I'm lending as a person. I'm lending to another individual. Bonds is generally you're going to be lending to companies, to institutions. So it's a glorified fixed deposit with institutions. So you will have names like, let's say, Adani Power, let's say like Tata Power. So you're actually doing a fixed deposit, not necessarily with a bank, but mostly with companies. So that's the most uh, let's say, I would say non-technical way of putting it. Okay. So to get a little more understanding of why we've looked at liquid loans as a liquid bonds as a platform, and to understand the nuances of this, what we're going to do very quickly is I'm going to be getting in Gotham from Liquid Bonds, and Liquid Bonds is again one brand name, and Gotham will very quickly tell you all, give you all a company hierarchy in terms of what is it that they do, the entire brand structure, and things of that sort. So Gotham, in his previous avatar, was also CEO for Liquid Loans, and he will give you all an understanding about what happened with Liquid Loans, what changes happened from a regulatory standpoint, and tell us anything and everything there is to know about these products. For those of you who have questions, for those of you who have clarifications, please use the chat box unless I have asked you all if there is something that you would like to ask. Use the emoji, the hand icon, and then we will address that as and when the situation is appropriate. As always, when you're looking at asking questions, at least then have your videos turned on and then unmute your lines. Otherwise, please check if your lines are muted so that there is a pleasant learning experience for all of us on this call. All right. With that said, Gautam, the floor is all yours. I'm sure you have share access. Let's begin.
Thanks. Good morning and welcome to all of you all, and thanks for inviting me. I see quite a few people have joined on a Saturday morning, so I think that speaks a lot to your following. Today, I'll probably break the presentation into three parts. We'll start off with our background as well as what we did at Liquid Loans. Some of you all would have been investors at Liquid Loans also. So try to give you an update of what's happened in that business over the last 18 months. Then move on to why we feel bonds is an important product in today's times. And towards the end, we'll get deeper into what an OBPP platform is, how do bonds work, why do we feel it's a great asset class to be in, and then open up the floor for Q&A. Funny, next, please. So quick overview, the NDX or Liqui Group comprises of three entities as we speak. Liquiloans was the business that we initially started back in 2018. This was a peer-to-peer NBFC, or P2P lending as it is popularly called, regulated by RBI. In the P2P space, we started in 2018, and up until 2024, we were the largest player in the space, owning over 60% of the total market share. And in 2024, RBI came out with new guidelines. So on another side, I'll go into more detail on what we did thereafter. The other line of business that we have is a regular NBFC to a company called Trillion Loans Fintech Private Limited. This is a JV that we have with Bharat Pay, which is a unicorn entity with about a $3 billion valuation. This entity lends to does lending in the consumer loan space, merchant loan space, as well as the fintech lending partnership space. As we speak, the net worth of the Trillion Loans entity is over about 450 crores. with an asset size of 1,200 crores plus. And the most recent entity that we have incorporated is called Liquibonds. This is a OBPP license holding entity. OBPP is an online bond platform provider license, a license that SEBI came out with about 3.5 years back, which allows platforms that have taken the license to provide a debt platform for people to purchase as well as sell bonds in a seamless and convenient manner. So at a group level, all of these three entities have done well, and the hope is some of these businesses scale much better in the future. Next, please. So quick background about us as well as the team. So the NDX group was started by myself as well as my co-founder Achal Mittal. Prior to this, both of us were co-founders at an entity called Rento Mojo, which is the largest online platform in the country as we speak for rental of furniture, appliances, laptops, fridges, etc. I have completed my MBA from IIM Calcutta and then worked with companies like IFL Wealth as well as Housing.com. And Achal has completed his MBA from NMIMS and then worked with HSBC as well as Citibank and ICICI. Apart from this, obviously, we've got a very strong senior leadership team who is responsible for all of our growth over the last few years. Next, please. So some of y'all had already invested into our previous product in the P2P lending space. Quick background on what we've done there over the last 18 months. So prior to August 2024, when RBI updated the guidelines for P2P lending, we were the largest player in the space with about 5,500 crore of assets. Since the update in August 2024, we as a business took a very conservative call because we felt the new set of guidelines are not very congruous to the business model that we were building, which was very investor focused, ensured that investors got a certain return with minimal risk. The new set of guidelines did not fit very well into that model. So we took the hard call of shutting that business down. Over the last 18 months, we focused on ensuring that the book unwinds very cautiously and correctly, and no investor who had invested with us prior to that got impacted. So very happy to share that almost 98% plus of the funds that we had on the platform have already been returned to investor, and not a single investor has taken a single rupee of principal or interest lost in the last 18 months. So this has possibly been one of the most careful and responsible unwinds of a portfolio of this size that we would have seen in the entire country. And now we have pivoted to the bonds business, which is very similar in terms of what it offers to the investor in terms of risk as well as return, which I'll probably go into more detail in the oncoming slides. Next, please. Yeah, so before we get deeper into bonds specifically, I think a little bit of context is very important here, right? So if anything, the last 4 to 5 years or 6 years, I would say, have been extremely volatile, right? We've seen COVID, then we've seen the second wave, then we've seen the recovery after that. We've had 2 glorious years of equity return. Then we've seen the Russia-Ukraine war in the midst, and now most recently the Iran war, right? So I think the learning, if any, here is that the world is now heading towards an extremely uncertain time. It is very difficult for any one individual to predict precisely what's going to happen in the future. And the impact in such a globalized world can come from a war which is far away from the country and can impact very important portions of our economy as well, right? So the option as an investor here is to ensure that your portfolio is adequately diversified and you're not overexposed or underexposed to any particular asset class. In the absence of clear visibility as well as predictability, the only option as an investor that you're left with is to ensure that you're well diversified across relevant portfolio classes that make sense for your risk appetite. Next, please. Right, so just quickly jumping into, I'm sure all of you all are pretty aware of this already, but just trying to cover the base here across asset classes, right? So gold, we've historically learned, is a very strong hedge to whatever happens in the global economy or the Indian economy, provides high amount of liquidity. There is no credit risk because you're not taking a bet on any government, any entity, any corporate. But the challenge is if you take physical gold, storage becomes an issue. It is not a asset class which is inherently coupon bearing or interest yielding in nature. And what was considered to be an extremely safe asset class with very low volatility has become an extremely volatile asset class over the last 2 years, right? So it still remains a very strong storage of value. But as an investor, you have to align to the fact that something as unvolatile as gold in the past has also become a volatile asset class. Equity obviously is the best asset class for long-term wealth creation. It beats inflation and is linked to inflation, provides high liquidity. Having said that, it is not a great asset class for a short-term horizon, right? So for any investment that you want to park for less than 3 years, equity may not be the best fit. Real estate again is an asset class loved by Indians. It's a tangible asset, gives you social status, gives you rental income if you rent it out or lease it out. But ticket size is extremely large, high entry barrier. It's an illiquid asset class, and at a individual level, it becomes very hard to diversify, right? So if you take a single real estate exposure, it might account for a very large percentage of your portfolio. Another asset class that's been loved by investors in the country, or especially retail investors, has been fixed deposits. So they are by far the safest asset class, comes with a certain degree of protections through DICGC as well. Very safe, easy to understand. Having said that, returns do not generally beat inflation. Although the product is liquid, it comes with an exit load when you do desire to exit. And it's not a product that gives you long-term wealth creation. So again, to repeat, so these are two individuals who are really vested with the equity market, right? Nikhil Kamath and Nitin Kamath of Zerodha. Both of them, in spite of getting a large percentage of their company revenue from equity, have been consistently saying diversification is the only way to move forward, right? Because you don't know how well a particular asset class will perform either in the short run or in the long run. Investors need to safeguard their portfolio by ensuring they are not exposed to an asset class which underperforms in the next 5 to 10 years, right? Especially if they've taken concentration risk at a singular asset class level. Next, please, Pani. And that's held out too also, right? Whenever you look at actual performance of asset classes across time horizons, you will see asset class tend to perform in chunks. There'll be a couple of good years followed by a couple of moderate or low return years. Then they'll come back and outperform a few years down the line. So consistently, there's a rotation in the leadership shown by different asset classes over a long period of time. In the next slide, Pani. This is the asset allocation quilt, right? So what this shows is the rank ordering of asset classes on an annual basis. As you can see, it's completely checkered, right? So essentially, no single asset class has consistently outperformed over a 2-3 year period. So the winner in a particular year drops to the bottom half in the next year, then possibly returns to the top half in the next year, will outperform maybe a couple of years later, right? So the only learning that I get from this slide is that if I'm well diversified across all these asset classes, the likelihood that my portfolio gives the same level of return with a much lower downside risk is going to be significantly higher, even as compared to if I were invested into a singular asset class. So the risk return paradigm for a well diversified portfolio will tend to outperform a single asset class at any point in time. What's also happened, especially in the Indian economy in the last few years, is both due to inflation rate coming down, as well as the GDP growth rate moderating. The nominal GDP growth rate has come down from low double digits to high single digits, right? And whenever that happens across any geography, equity returns tend to moderate alongside, right? So equity returns tend to mirror the nominal GDP return rate over the long run. And whenever there's a moderation in the nominal GDP itself, listed companies, especially which are large and well penetrated, will find it slightly harder to outperform the nominal GDP growth rate. They might outperform to the extent of a couple of percentage points, but rarely have the equity returns on a 5 year, 10 year time frame outperform the nominal GDP growth rate by more than 2 to 3%. So this is one reality that investors in India will also need to brace up for, that equity returns are no longer going to be the 14-15% or 13 to 15% range that one was expecting in the past decade or so. It is quite likely they'll moderate to a 10 to 12% range going forward. What's also true, I think, globally is that whenever markets tend to mature, and capital availability increases, companies prefer to not consume a lot of equity capital, which is generally considered to be a higher cost source of capital, and tend to lean towards the debt markets as there is more certainty in their business model. So most developed economies will tend to have a much larger bond market as compared to the equity market. Obviously, a large percentage of the bond market is dominated by government entities, skills. But even the corporate debt market tends to be a larger percentage as compared to developing economies. But as India also grows, right, and India starts growing up in terms of both nominal GDP as well as per capita GDP rates, the Indian debt market is also poised to become as large as some of the other global geographies. Next, please, Pani. So a lot of steps India has already taken, right? Both the regulators have said they want the corporate debt market to be more liquid, more active, because constant availability of capital at reasonable cost becomes an important ingredient to growth of any economy. So as India also grows, SEBI in particular has tried to take a lot of steps to ensure that the corporate bond market grows, right from retailize or trying to retailize the Indian corporate debt market through an OBPP platform, bringing down ticket sizes for NCDs and bonds, as well as giving a lot of fillip to the participation of investors across the curve. And there's been a concentrated effort to also ensure that there's liquidity in the debt market, which attracts a large number of investors. So broadly, what are the options if you look at diversifying in the fixed income space, right? So most of you all are aware of savings accounts where rates have come down from 4.5% in the past to as low as 2.5% for a bank like HDFC today. Fixed deposits also tend to mirror RBI rates very closely, and at this point in the interest rate curve, we're at 5 to 7% yields for most FDs, right? Up to 2 to 3 years. Debt MFs also tend to focus on very high quality assets, and by extension, the expected returns don't tend to outperform or are generally in the range that FDs provide. So small savings account either come with a maximum limit that one can invest, say a lakh and a half for some of these products, or the ones that are more freely available, tax saving bonds and the likes, tend to come with a lower yield available. So bonds emerges as an important alternative in the fixed income space. You will get bonds which are AAA rated all the way up to a BBB rated bond. Depending on the credit risk that you're willing to take, rates will be mirroring the risk that you're taking. And it becomes one of the options that within the fixed income space allows you to outperform inflation, right? So if one looks at the official number of inflation, it's about 1 to 3%. But for most people of your groups, the effective inflation rate is more likely to be 5 to 7% because your consumption basket is very different from what the official consumption basket considered for inflation is. So when you look at a 5 to 6% inflation number, if any asset class does not provide you a 5 to 6% return, it effectively is eroding your real wealth. So anyone who's willing to look into this category can, understand the products available a little bit better, do their own research, and has the likelihood of making a double-digit return even in a fixed income product. So now, before we get into how bonds fit into your portfolio, it's probably a little important to understand in detail to assess what the risks associated with bonds are, how do bonds work, and how do they compare to other fixed income products. What I've tried to do here is just give you an explanation through an analogy of how a bond works. This is not intended to compare a bond with a fixed deposit product. This is more from an educational perspective for you all to understand how bonds work and how do they compare to other options out there. So when you do a fixed deposit with a bank, and we'll take an example of a 10 lakh rupee account. When you go and do a 10 lakh rupee deposit with the bank, it is a one-to-one agreement between you and the bank where you're lending the 10 lakh rupees to the bank with the intention of earning a certain interest rate. What does the bank do with that money? It lends it further to either corporates or to the government or to individuals in the form of a home loan, auto loan, personal loan, or a credit card, earns a certain interest on that amount, and thereby they are able to pay you the interest that they've promised. So, say you've done a FD at 6% with a bank. Bank will lend the same 10 lakh rupee amount in say in a ratio of 20% to the government, 40% to corporates, and 40% to individuals at a blended ROI of 11%. They will have their operational costs, they will have some potential NP also across all these borrowers, and make say a 8 to 9% return on the funds that they have lent out. From the 8 to 9%, they will return 6% back to the investor, and 2 to 3% becomes their spread or their ROA. Now, the advantage or disadvantage with an FD are the following. An FD is generally considered to be a very safe and secured instrument. Any amount invested with a particular bank for an amount of up to 5 lakh rupees is secured under DICGC. So you're not taking credit risk on that particular bank. Any amount beyond that 5 lakh rupee limit, you're taking a slight amount of credit risk on the bank, although the likelihood of default is quite low. Now, if I compare this to a bond, the underlying nature of the instrument is very similar. You're lending your money to a corporate or an NBFC in most cases, who is using that money to lend further to a set of individual borrowers or corporate borrowers. The NBFC also earns interest like a bank and pays you a slightly higher interest rate than the bank would pay you on your funds. Now, when you do the same amount of lending to a corporate, say a power plant or a steel plant, a company in the manufacturing space, they will use those funds to fund their capex. Through their capex, they will earn a certain return over the period of time, and thereby they are able to pay back the interest that they had promised as a coupon rate on the bond. So the underlying nature of the instrument is very similar. It is a loan provided by the instrument or security holder to the company, which is the borrower in this case. The borrower tries to earn a higher interest rate either through lending to someone or by setting up a factory or a power plant or a steel plant, generate a certain return on the capital deployed, and pay back the promised return to the investor. In both these cases, there are three sets of risks that you're taking. First is the credit risk. So if you lend money to an NBFC or to a company, if they are not able to generate the right amount of return, it is possible that they default on the commitment made to you. You could lose both your interest as well as the principal amount invested. Now, bonds in addition are a tradable instrument. So when you want to withdraw an FD, you go to the bank and ask for your money back. Since it is a one-to-one contract, the bank nullifies the contract and returns you your money with a slight exit load in most cases. Whereas a bond is a tradable instrument. So it is like a share that you hold of a particular company. If you want to exit, say 100 shares of Reliance that you bought in the past, you do not go back to Reliance and say extinguish these shares. Since it is a tradable security, you sell those shares in the secondary market to another willing buyer of those shares. Similarly, bonds, whenever they need to be redeemed before the maturity period, you cannot go back to the company and request for a withdrawal. Since they are tradable in nature, say Pani wants to sell his bonds, he can approach Sharath either on the exchange or through an OBPP and sell his bonds on the respective platform, thereby getting an exit. Now, what are the advantages and disadvantages of this model? The advantage is that because it is a tradable security and not a one-to-one contract, there could be many willing buyers. So to that extent, the likelihood that Pani needs to take a exit load or a haircut on his investment is much lower. What is the con of this arrangement? The con is that it is possible that when Pani wants to exit, he is unable to find or source a buyer. And therefore, although the exit load is low, he may not even get an exit on the instrument. And at the same time, in a dire scenario, he can't approach the company and ask for liquidation of the bond. He will have to necessarily wait till the maturity of the bond. So similar to an FD, a bond also tends to have a maturity period. It could be 1 year, it could be 3 years, it could be 5 years. So in the worst case, the bondholder will have to hold the bond till maturity, at which point of time the company that has issued the bond is obligated to return the entire principal as well as any outstanding interest. Sharath, I'll just pause here if there are any specific questions because it's an important slide, and then move forward.
Not really, Gautam, because I'm seeing the chat. It is completely, I mean, there are no questions as of now. And quite frankly, the audience is, let's say they've got a brief understanding of this, they've got a context to it. So we can definitely continue.
Great. Funny next, please. Right. So now going into some technical details of a bond. You as an investor are willing to invest 10 lakh of rupees. Generally, when a company issues bond, they also go through something similar to what an IPO happens in the equity market, right? So, in the case of bonds, the company that is issuing the bonds is called an issuer. They will either do a private placement or public placement of these bonds. And this is called a primary issuance of this bond, of the bonds. Individual investors, corporate, institutional investors can participate in that issuance and purchase these bonds. Say the total issue size is 100 crores and I as an investor have bought 10 lakh rupee worth of bonds in that issuance. Now, once my money is invested, the company will use those funds for lending out or for capex and try to generate a return. The company also promises to pay a coupon rate on a regular interval. That interval could be a monthly interval. Say it's a 12% coupon bearing bond, in which case they will make and I'm just oversimplifying here, a 1% interest rate payment or interest payment on a monthly basis. So 12% over 12 months. And at the end of say 3 years, which is the maturity period, they will return the entire 10 lakh rupees back to me as an investor. The coupon payment also could be a quarterly payment, could be an annual payment. And so in certain cases, there's a concept called a zero coupon bond, where the company issues the bond either at a discount or at a face value. Say a 100 rupee bond might be issued at 70 rupees. There is no interim coupon that is paid out for the 3 years. At the end of those 3 years, that bond is redeemed at the full value, which is 100 rupees. So as an investor, I do not get any interim coupons, but a 70 rupee bond is exited at a value of 100 rupees when the bond is fully matured. Now, in the interim, in those 3 years, like I already mentioned, the bond also has a trading value. So the bond could trade at a premium or could trade at a discount. The way to understand this is, say a company has issued a bond at a 12% interest rate. Now the interest rates in the economy have come down since then, because RBI has brought down the repo rate, and most new issuances in companies of the same caliber or of the same credit rating are happening at 10%. In that case, I as an investor will find that the 12% coupon that I've subscribed to is now giving me a much higher rate than the market. So if and when I do want to exit this bond, I will not be willing to sell this at 100 rupees. I will want a premium, because all other issuances that are happening at the same time give a payout of only 10%. I will be willing to sell this bond at only a minimum price of say a 104 or 106, depending on the outstanding tenure of the bond. So in the interim of those 3 years when the bond matures, the actual price of the bond, which is traded in the market, could be at a price higher than 100 rupees of face value, or could be at a price lower than 100 rupees of face value, depending on the interest rates, depending on any credit upgrade or downgrade of the bond, as well as the market sentiment around that company, as well as liquidity surplus or deficit available in the market. Having said that, if you as an investor hold the bond till maturity, you will make exactly the same return that you had bought the bond at. So if you bought the bond at a yield to maturity of 11%, you will earn the 11% rate if you hold on till maturity. But your return could be higher or lower in the interim if you decide to exit. Now, what's happened over the last few years, right? So historically, as is the case with most developing economies, bonds tend to be a more popular product in the institutional market. Large companies, large pension funds, LICs of the world tend to be the more active participants in this category because a lot of their maturities, a lot of their requirements mirror what bonds have to offer. And individual investors tend to be a smaller percentage of the bond market in most geographies. But I think India is a market which has bucked the trend both in equity as well as hopefully in fixed income in the future, where individual investors combined together at the aggregate level tend to become very large participants, as we've seen with the equity markets, right, where our SIP flows are now close to about $3.5 billion a month, and lump sums are a similar amount. Compared to most geographies, the percentage of equity market holding of individual investors, both directly as well as through mutual funds, are a much larger percentage as compared to most other global geographies. A similar story is likely to play out in the bond markets also. And the regulator has taken very active and very customer friendly steps in that direction, right? So, one of the things that used to happen is most bonds or NCDs in the past used to have very high ticket sizes, sometimes 10 lakhs, sometimes a crore. Now the regulator has taken a very active direction to bring the ticket size down to a very friendly beginning face value of 1,000 rupees to 10,000 rupees to a lakh rupees in most cases. Accessing the market was both difficult and challenging for a retail investor. Through the OBPP platform or through the OBPP construct, it has now become as easy as investing into a mutual fund. Both investments and withdrawals have become very, very easy. So with a layer of convenience, with lower ticket sizes, and with very active direction by the regulator to make this a retail product, I think in the next few years, you will see this will become a very important part of asset allocation for a large set of investors. So what is an OBPP platform? A OBPP platform is a license that allows, say, someone like us to provide an online platform where, say, Sharath can come in as an investor, register himself on the platform, look through all the bonds that are available on the platform, and through a very simple process, purchase any bond that he so desires. Similarly, when he wants to exit, he can come back to the same platform and try to exit. So think of it as a mini exchange, which is very user friendly and convenient. That and therefore ensures that investors have a very simple, transparent way to approach this category or asset class. In addition to this, because it is regulated by SEBI, it comes with all the sets of investor protections, scores platform, completely KYC and investor compliant platform that you would get with any other SEBI regulated products like mutual funds. Now, what are the advantages and features that bonds offer, and where do they fit in, right? I've already covered, but I'll try to harp upon the risk before I come to the features and benefits. So there are two or three sets of key risks that you're taking with any bond investment. First is the credit risk. The entity that you're lending to, is it a credible entity? Is it a good quality entity? And what is the likelihood that it goes into a bad credit event where, either due to internal or external stress, it is unable to make your coupon and principal repayments. So that is by far the largest risk that you're taking with any bond investment. The second risk is a liquidity risk. And I'll try to cover in the future slides how we've tried to mitigate all these three risks. But what I mean by liquidity risk is that if you want to exit your investment at any point of time, is there a buyer available? Will you be able to find the buyer, and will you be able to execute the trade in a simple and convenient manner? And the third risk is an interest rate risk. So when you're holding the bond, and if you intend to exit before the maturity period, then the price could be higher or lower than what you've invested at, resulting into either a capital gain or loss. This risk gets mitigated if you hold in maturity. It is a risk that plays out only if you hold the bond and intend to exit before the end of the maturity period. Now, quickly jumping to the benefits and features of most of these bonds. So one biggest advantage that most investors who invest into bonds as well as FDs like is that it gives you highly predictable income. So when you're investing into the instrument, you exactly know what the return is going to be, right? So if I jump back to the previous asset classes that I discussed, when you're investing into gold, you don't know what the 2-year return or 3-year return or 5-year return is going to be. Same holds true for the equity market. Same holds true for the real estate market. The biggest advantage of bonds as well as FDs is that the expected return is predictable as well as known in advance. The second biggest advantage is that there is a high degree of capital protection, right? So unless things go absolutely and terribly wrong, it is almost unlikely that you will lose your capital. So there is no possibility that you see a mark to market of 10%, 20%. If there's a war happening like it is right now, you will not see a mark to market in your portfolio in any meaningful manner. And if you do, in a year or so when the bond matures, you will get your full principal back, right? So it comes with a high degree of capital protection. Not to say that this is 100%, but the likelihood of you losing principal or capital is much lower than most other instruments. Again, it comes with a defined maturity. So you exactly know when you're going to get your money back. And now with platforms like us, bonds are highly tradable. So they were always liquid in the past, but the amount of buyers and sellers used to never be in a equilibrium. With platforms like us, there is a very strong endeavor to ensure that there is high liquidity on the platform. So as and when you want to exit becomes as simple as exiting, some stocks in the equity market. Again, one more advantage is that this is one of the asset classes which is completely diversified, right? So historically, equity and gold were supposed to be inversely correlated, but in the last 5 to 7 years, that correlation has gone for a toss, and a lot of times you see both the equity as well as gold markets moving in tandem. So then, in such a case, you actually need an asset class which is genuinely diversified and tends to give you downside protection when the markets are volatile. One big advantage that a lot of investors like about bonds is they come with a monthly interest coupon, right? So anyone who wants a certain percentage of their monthly expenses taken care of, or wants a certain cash flow for a particular reason, this is one of those asset classes which can provide you that predictable fixed income either on a monthly or a quarterly basis. Funny, next, please. Right now, so coming to the risk, right? Although I mentioned that credit risk is an important element of any bond investment, but it's also important to understand the academic concept around this. So whenever a company goes into a period of stress and say it goes into liquidation, a company say which had a balance sheet of 1,000 crores, out of which 300 crores was equity and 700 crores was debt, and they had assets of a similar size and scale. Now, if that company were ever taken into liquidation, whatever proceeds are received by either liquidating the company or by someone taking over are first paid to the debt holders of the company. So in this case, let's do a stress test of three scenarios. If, say, the company's assets were to be liquidated and only 300 crores were to be received, then that 300 crores will get distributed to the debt holders first, and equity holders will not get any return on their investment. If the amount received back was, say, 700 crores, then the debt holders would be paid in full, and equity holders again would not be left with any residual amount. In the third scenario, where the company's assets of 1,000 crores are liquidated for greater than 700 crores, then again the debt holders get paid in full, and the residual amount goes to the equity holders. So this is a very important concept to always remember, that whenever the company goes to liquidation or through a period of stress, it is contractually obligated to always pay back the debt holders first. So although credit risk exists as an important element of bond investments, whenever things do not go in your favor, it is quite likely that as a debt investor, you are significantly more protected than an equity investor. And a lot of the bonds that you will see on the platform are listed firms. So some of these listed firms, if they were to go through stress, their equity values are more likely to drop first and probably go to zero before your debt investment gets impacted in any meaningful manner. Next, please. Now, it's also important to understand where bonds fit in, right? So the primary fitment, I feel, is from a long-term asset allocation perspective, right? Because if you are not confident of where the markets will be, where the gold price will be 10 years from now, the only option that I feel you as an investor have is to ensure that you're well diversified across 3 or 4 asset classes, so that if things do not go in the direction that you feel or expect, you're at least protected, and some part of your portfolio is generating a good return and is principal protected in nature. But beyond that, I think it's a great product for the short term, right? So today, when you look at a 1 to 2 year horizon, most investors gravitate back to, say, a liquid fund or a FD as one of the only safe investment options available. You can't potentially make a gold investment for a 2 year period, nor is equity markets recommended allocation if you want to invest for 1 to 2 years. So the primary fitment of bond, apart from long-term asset allocation, is for any other short-term investment need that you might have, including emergency parking that you do, right? So all of those proceeds or all of those parts of your portfolio can be very safely allocated into bonds. Now, in addition to that, let's say you have a clear financial goal a year or 2 years down the line. Could be as simple as purchasing a car, doing a large insurance policy, could be your child's education, child's marriage. Any of these use cases where you know there's a planned expenditure X number of months down the road, those funds need to go towards a fixed income product so that there's no volatility in the value of those funds as and when you want to withdraw. Second, again, from an asset allocation perspective, as a person nears retirement or nears a higher age, it is highly recommended that you reduce the risk in your portfolio, reduce the equity allocation, and start inching up the fixed income allocation in your portfolio. So as you near retirement, you should gradually ensure that there's a certain percentage which is reallocated to fixed income, thereby insulating your portfolio from severe downside shocks, if any. And another use case that will now become more popular as markets go through more cycles is whenever markets are overextended or close to peaks, or when the PE ratio is very high, it'll now be recommended that you move part of your portfolio back to a different asset class, do a little bit of profit booking, so that you don't then see an extended period of low returns. And finally, any surplus cash that you've got in your savings account today is very depleting from a real value perspective, right? So when at 2.5%, you're significantly underperforming inflation for any funds that are lying in your bank account. Any money that you don't intend to use in the short run for, say, a couple of months should be parked towards a product which at least gives you a more respectable return. So we took our an OBPP license. We'd applied for it earlier, but we received our OBPP license in July 2025. In the last few months, we've already built a complete online platform. The intention is for investors who've worked with us or lenders who've worked on the P2P platform, to build a platform that is as easy and convenient to use, both to enter and exit your investment. So what we intend to do with the tech platform as well as our demat license in the near future is to make the journey of investments into bond as easy as one can imagine, probably mirroring what you see with the equity markets, right? Where today, at the click of your button through your laptop or through your phone, you can enter and exit stocks in large quantities if you so desire. So our intention is to make bonds as liquid an asset class, as simple an asset class, and as convenient to use a product. We'll be spending a lot of time on awareness, education, explaining the concepts around bonds, so that when you are entering this product, you understand the risk as well as returns completely before you invest. So quick glimpse of how it works, right? So once you've logged onto the platform and created your account, there's a curated list of bonds that is available on the platform. In addition to that, we have a good amount of literature around the credit rating of the bond, who the promoters of the company are, what their financials are. So almost all the information that you will need to assess the company individually is also present on the platform. So unlike the equity markets where the information sits outside the platform and you're required to do your own research, almost all the information that you'll need is already available on the platform for each and every bond that is listed on the platform. So this is our endeavor towards ensuring that an investor is able to take a informed call in whichever entity is investing into. Once you've invested into these bonds, we've got a very simple, easy to understand dashboard where you can look at which firms you've invested into, what is the maturity period of those bonds, what is the coupon payout frequency, and so on. And whenever you intend to sell, if you do desire to do so, the platform will continuously endeavor to ensure that you get a exit as soon as possible. This has been one of our USPs, even in the liquid loans avatar, where we were able to ensure at scale, at a much larger size than at which we are at right now in liquid bonds. We were able to ensure that investors wanting liquidity were able to get liquidity. So it will remain a continuous endeavor as a platform to be able to provide a similarly liquid platform in the liquid bonds avatar as well. Right. So I think although there's a certain amount of risk with bonds, a lot of the risk perception actually comes from lack of awareness, lack of understanding, and lack of access to clear information around bonds. Now, this is precisely the gap that we intend to bridge, right? So, go back to like 2002, right, when equity markets were not and mutual funds were not as popular a category. Over the period of time, there has been so much literature, so much awareness, so much newspaper articles around that category that most investors now not only do not fear the category, they are extremely confident. What we intend to do is something similar with bonds, that we feel it's a great product and great asset class for investors to be invested into. The gap right now is there was a lot of opaqueness to information. There was a high barrier to entry, and access was not convenient. It was fairly complex in nature. Most of these problems we'll try to bridge, ensure that everything is super transparent to the investor. Access is easy, convenient, and there is full visibility on your portfolio. Once this is done, I feel this will find a very, very strong favor in most investors' minds. Now, I'll also try to cover what we feel our value add in this entire equation is, right? So, we come from at a group level a risk management background ourselves, right? By virtue of running two NBFCs, our bread and butter business was assessing credit risk and underwriting that risk, right? So the same capability we are trying to extend to the corporate bond market now. One of the key differences that we're trying to do as a platform is, instead of being a horizontal platform and listing all bonds, we are curating the list of bonds that we are listing on the platform. So we are doing very detailed and deep due diligence on each of these companies that we are listing, and listing only the firms that we confidently, or once our team has assessed, we are confident that it is in the best interest of investors to invest into the bonds, right? So a large step in terms of curation, due diligence, risk assessment has already happened by the time you see a bond listed on the platform. So just to give you context, about 700 to 800 companies have listed bonds Indian ecosystem, and out of which we've curated down only about 30 to 35 names, and those are the ones that are listed on the platform. So our curation ratio is almost to the extent of 95%. Only about 5% of the listed bonds exist on our platform as we speak. Second USP that we are intending to build as a platform is very, very high liquidity, where at any point of time there is flexibility for you as an investor. Although you might have invested with a horizon of 2 years or 3 years, but life and money is uncertain. You might want an exit 2 months later, 3 months later, 6 months later, either for an emergency or for any other reason, or if you find the markets attractive. So our endeavor as a platform is going to be to ensure that whenever you do want an exit, there are enough buyers on the platform to be able to provide you that exit. And finally, a lot of our focus, as you would have seen, even with the liquid loans wind down, has been very investor first in nature. Even our construct in terms of commercials back then was very investor focused. And that has played out well, both for the investors as well as for us in the long run. We will continue to adopt this approach. And one of the biggest things that we're doing to validate this is that on each and every bond that is listed on the platform, at a group level, we are purchasing these bonds first, right? So there's ample amount of skin in the game in each and every bond that is listed on the platform. So it is not as if we're acting purely as a broker and saying, Sharath, you go and invest into these bonds. Things go right, great for you. Things go wrong, your loss. In all of the bonds that are listed on the platform, the group will have some or either small or big exposure. So whenever there's a credit event or there's a stress event, we will also be taking a certain amount of hit. So this ensures that there is good alignment between the investor and the platform, and all the bonds that are curated with the absolute highest degree of due diligence. That's all for now. We'll open up the floor for Q&A. I think there are a couple of questions already there. Sharat, I'll over to you.
Yeah, so that is mainly taxation. So I'll make it very simple for the entire folks once and for all. Bulk of them being salaried folks, I think one of the biggest concern that they have, especially because if they're in the 35% tax bracket, that aspect hurts a lot. So obviously we'll address that in just a bit. But other than that, ladies and gentlemen, I don't see quite a few questions apart just from the taxation angle. Is there any questions that you'd like to ask? Now, questions need not be just in terms of questions itself, but if there is any clarifications or any thoughts that you'd like to share before I move into the direction of, okay, what kind of money should be allocated here? What's financial goal, or how is it that we're going to be participating in this asset class? Because my recommendations will be something that Gautam and his team may not need to be on this call. Therefore, I would want us to ask any clarifications or anything pertaining to the product as such to be addressed or to be asked now, so that if there's any aspect that I'm not very sure of, can be addressed by Gautam and his team. Okay, I see, Funny, you've raised your hand. Let me unmute your line, and yep, you can unmute your line.
Yeah.
Turn on your video on, and if you can ask the question.
Okay. So point that I wanted to ask is like I don't know, maybe I didn't I know that it was clarified. So on this platform, OB Liquibonds platform, it's the bonds that are listed are only for it's like a secondary trading, or it like, and the bonds are directly from whichever is the corporate which is publishing the bonds.
That is correct.
Is it a mix of both, or it is it's only I mean, we buy from corporates and then put them here uh, for trading, or you put for exchange?
Great question, sir. So currently, all the bonds that are listed are pre-existing bonds. The way it works is, let's say I am JSW Steel. I intend to do, I want to raise 1,000 crores to fund my capex. I do that in the month of Feb 2026. But because the capex is not a short-term funding, it's a 5-year to 7-year cycle, they will issue a 5-year bond. So a company will do a public issue only once in a while. Post that, those bonds are continuously traded in the secondary market. So all the bonds that are listed on the platform currently will be bonds that we have purchased from the market or are listed on the platform through the secondary market. Public issuances generally tend to happen directly, where you can participate through your broker or through your demat account directly whenever such an issuance exists.
Okay. Once we buy from there directly, and then we can list here, is it? If you want to be
Yes,
participating, or it is only like a whatever that you purchased, we can buy and sell.
those can also be listed, sir.
Okay. Yeah. Thank you.
Nice question, Funny. Anybody else? Okay, now Gautam, this was a standard presentation that we did. I mean, obviously, you all don't generally work with customers directly, because your entire framework or your strength has been working with financial intermediaries like myself. I know this presentation has probably been a little different from what you'll currently do with the rest of the audience. But is there anything else that you'd like to tell about your company in terms of the direction that you all are taking and so on and so forth, so that because a good number of a good majority of the folks on this call have already been investors of liquid loans, right? So unfortunately for us, while we are saying that, okay, now this doesn't exist anymore, the initial perception is that, okay, there's something that has gone wrong with the product as such or with the company as such, and therefore these things have been that's for this particular product has been discontinued. While we have very categorically said right at the start that there has been no loss of capital to any of the investors who've gone through the liquid loan route. If there's anything else that you'd like to highlight in that case.
Sure. So I think there is possibly a misconception that something's gone wrong, but that obviously is not the case, right? So it's been 18 months and we've unwound almost the entirety of the portfolio. Whatever remains is also because of the fact that, some loans were slightly longer tenure in nature, and they will take their natural time to unwind, right? In the interim, I'll just throw some light on why we took this call, right? So when we had done or we had constructed the product around P2P lending, we had done with a certain set of pillars in mind, right? Where there's a certain amount of skin in the game that platform has. The investor does not bear the first loss as soon as the first NPA hits the portfolio. Entry and exit is easy, right? Because as we understand, individual investors, no matter how savvy they might be, they will not have the time nor the willingness or the inclination to go and individually select borrowers on a P2P lending platform, right?
That is correct.
So
That
we
is correct.
wanted to build a convenient layer over the underlying asset class, which was retail borrowers. Now, with the new set of guidelines, uh, some of these pillars of the business that existed for liquid loans in particular no longer exist, right? Where individuals are now required to go onto the platform, individually select borrowers. Money that you will get back will come in small increments as and when those borrowers repay. So it requires some extra tracking, managing, evaluation of the portfolio on a continuous basis. Now, what obviously comes with extra effort, extra time is an expectation or a valid, I would say, very valid expectation of higher returns. Now, when an investor or lender on the platform wants higher returns, the platform is then required to find or source borrowers who are willing to pay a higher interest on their loans. Now, as a business model, we had focused on the absolutely topmost set of borrowers, right? So even today, I can very proudly say that our default rates will be better than not just the P2P lending NBFCs, but amongst some of the most well-known names like Bajaj Finance and Tata Capital of the world, right? We would probably have one of the lowest absolute default rates across the entire country. So our business model was entirely built around low returns to the investor and proportionately or more than proportionately lower risk. With the new construct, that business model is no longer an appealing business model because the investor, by nature of the new guidelines, is required to take a higher risk, and to compensate him for that higher risk, a higher return will have to be generated. To generate the high return, the underlying portfolio will have to be riskier. So just to give you a very crude corollary, we were trying to build a very large cap kind of asset class. In the new format, it's more of a small or mid cap kind of asset class. It appeals
Micro cap, you would
obviously
like.
micro cap, I would like to say.
Uh-huh.
And that is not an area that we would want to build the business around because it does not fit in very well in our mind to the fixed income product segment. It will surely appeal to a certain set of the investors, but we wanted to build a more mass asset class which appeals to practically every investor for a certain percentage of his portfolio. So then I think it was obviously a very hard call to take, right? We were, like I'd mentioned, the market leaders at that point in time. To just abruptly pull out of such a dominant market position was not easy. We went through our own set of heavy discussions internally. But I think the driving factor was for us was very simple. The ethos on which we'd built the company was investor first. So if we felt that the new format will not be investor first in its approach and will not appeal to a large set of investors, to that extent the call became easier. But having said that, we as an entity have shown a very responsible approach post that and have ensured, we've spent a lot of time even at a large avoiding, jumping into any new business directly. So this event that had happened 18 months back, and only now have we started, very actively propagating the Liquibonds platform. For a very long period of time, all the internal energies were focused on ensuring a responsible exit to ensure that no investor, because all of them had trusted the platform to keep their money safe, faced any sort of untoward event. And now, very confidently, I can say that now that the ship has sailed, that has not transpired. All investors have returned their entire principal as well as return. Not a single investor across a 4 lakh plus base has seen any impact to their portfolio.
That's quite impressive because yes, I know of quite a few platforms in the P2P space that has unfortunately their investors had to not only see negative returns, but more importantly, loss of capital as well. There are quite umpty number of examples that are there on the internet. Nonetheless, Gautam, you also mentioned that there is decent amount of skin in the game that there's a decent skin in the game for the list of companies that are listed on your platform. Is there a specific percentage number that you'll actually deploy, or is this depending on the issue size of the bond?
So it's hard to honestly, Sharad, do a specific number because it's also a function of which bond is more popular on the platform, right? So there might be a specific absolute amount that we're putting in in say the 10 to 15, 20 crore range. But if a bond is more popular on the platform, you'll see a lot, much higher offtake, right? So say one of these bonds becomes very popular, does 50 crores in the first quarter, does another 100 crores, and does another 200 crores in the third quarter. Then on a percentage basis, the amount that we've invested will start becoming a smaller fraction, although on an absolute basis, we've not reduced our exposure.
Understood.
So
Okay,
think
good
of
enough.
as the equity volumes keep increasing in the market, if you as an investor hold a certain percentage, as a percentage of traded volumes, that percentage is always going to be lower. But as a percentage of the outstanding shares of the company, it will remain constant.
Got it. All right, that is good to know. You also mentioned about you all are putting in efforts to have a lot of education going around this asset class, specifically bonds for that matter. Are you all doing this on your YouTube channel? I mean, is there going to be literature that you all are going to be sharing? How is the education happening?
So as you understand, we are not a platform which is approaching investors directly, right? We tend to
Right.
work through financial advisors to a large extent.
Mhm.
So a lot of our communication and investor awareness also tends to happen through partners because they are well placed to, understand or cherry pick which investors fit into the asset class depending on
Understood.
their risk and return propensity. So a lot of our information flow will be through partners who can then curate whom and how much does it go out to instead of us, bombarding investors like a lot of the other platforms or products do.
What you're talking about. All right. I think that's all that I had for you because you've been very comprehensive and detail oriented throughout the presentation. Let me make one quick check and then we will, I will, I can have you excused. Folks on this call, anything that you'd like to ask pertaining to the platform, not necessarily how much money, what kind of money should get here. That is something that I will take post this. But is there anything pertaining to the platform that you'd like to ask? Yeah, funny. Go ahead. Unmute your line.
Yeah. So basically, this is more of like as it's mentioned that the whole bond market and then the more number of people participating in the bond market is going to pick up, right? So I mean, on this platform, since the bonds are going to be traded at a secondary level, now is it like from Liquibonds company there is see because more number of people on this platform will kind of create the demand, right?
Mhm.
The more number of people comes onto it or be aware of this platform, there'll be a possibility of people getting in and then trading in.
Right.
What Liquibonds is trying to do to onboard more number of there's a clear cut plan of like onboarding more number of people. Thereby, whatever is the bonds that are going to listed has a more number of participants to buy.
Good question. And Gautam will be very happy to answer. Gautam, I'd like you to take this one because I will answer this in another manner, but I'd like to hear from you first.
Sure. So I think for most importantly, right, and I think just like I mentioned, why will more investors? Since you asked this question, let's take a step back. Why will more investors participate into this, right? Historically, what used to happen, sir, is that if a company had issued, say, Muthoot had issued a 5-year bond, an investor who participated in the primary market did it with the expectation that he will have to hold on the bond for 5 years, right? So only a small set of investors actually participated in the primary market because either they did not have the willingness to hold for 5 years, or if they did have the willingness, they would find, an alternate asset like equity much more attractive than a particular bond over a 5-year period, right? Because post-tax returns could end up outperforming what he would earn on a bond investment. So one of the reasons why any market, right, will tend to attract a lot more participants is if it's a liquid market. To draw an analogy, imagine if the stock markets tomorrow declared that any stock you buy, you will have to hold on or it's under lock-in for a 5-year period. Then suddenly, even in a market as liquid as the equity or as NSE, volumes will dry up almost instantly. So the moment we go out and bring in an initial set of participants, and you're right, it's a chicken and egg situation, right, where investors will come in if they feel that there is going to be liquidity on the platform, and there will be liquidity on the platform only if investors come in. So to solve for that chicken and egg, the only advantage that we have is we had done something similar at Liquiloans in the past, where we created that initial liquidity, ensuring that investors got that confidence and every new investor effectively added to the liquidity on the platform. So obviously we've got a few tricks up our sleeve to ensure that this time around also we're able to accelerate that journey where when you come into the platform to invest, even if you purchase a 4-year bond, you will have a lot of confidence at the back of your mind that let's say tomorrow, next week, the month after, or a quarter down the line, if you want to exit that particular investment, you will be able to get liquidity on the platform. And not just liquidity, right? Because a lot of products in the market, including equity mutual funds, are liquid. The other consideration that comes into or pops into an investor mind aligned to liquidity is that when I do exit, is there a haircut or an exit load or a reduction in returns that I'm forced to seek when I do exit? So the idea here as a platform is that whenever you do want to exit, you should not get a bad experience of losing a couple of percentage points of your capital. Can you exit at what the market price is? Once that starts happening, the amount of investors I think that any platform in the market will be able to attract is going to be a very large number, because now suddenly from a 5-year investment, it becomes a investment that you can actually consider from a 2-month, 3-month, 6-month horizon as well. And the more there are a larger percentage of investors who are out there wanting to do a 3 to 6 month investment as compared to people who are willing to lock in their fixed income investments for a 5-year period. So I've sort of given you a open-ended answer, but I hope it answers your question well.
Yeah, I got that. I mean,
Funny, 1 second. I'll make this easier. Gautam, can I ask you from the liquid loans, the run with the liquid loans, currently, how many channel partners do you all still have in active collaboration?
Yeah, so we had about 4,000 odd partners at peak who are working with us in the liquid loans environment. A decent percentage of them have already started working here. Now, just broadly imagine if each of those 4,000 have about 100 investors each. So 4,000 into 100 adds up to the 4 lakh number that we'd seen in the past. And I think that's in the curated list of bonds that we've got on the platform. That number is large enough to ensure that there is ample liquidity available on the platform. Another point I'd like to bring in here is that in the liquid loans format, the group or the company itself was never allowed to participate on the platform pursuant to the regulation. So we as a company, even if we held 10 crores in a liquid fund or an FD, we could not invest a single rupee onto the platform ourselves to ensure that there's no intermingling with the investor funds. In this format, both the entity itself as well as any group entities can also be participants on the platform to the extent that they want. There is no capping to the likes of 50 lakhs or any other number. If you want to purchase a much larger amount of bonds on the platform, we can continue to participate either through the same entity or through group entities. So to that extent, we can also ensure that there is continuous and ample liquidity available on the platform at any point in time. So that is one additional flexibility that we have as a structural lever, which we did not possess in the liquid loans entity.
So funny, just to add on to, in terms of what's the thing, see, because at the moment, like Gautam was mentioning, we roughly have about 30 odd different companies, bonds that are showing up on the platform. Okay. 4,000 odd advisors, not all 4,000 are active. Let's say it's 1/3. So we have 1,000 advisors, 1,000, even if it is 100 families, because very rarely does advisor have less than 200, 250 families. But let's say 100 times 1,000, that's 1 lakh investors. Now we have the math, right? So as far as a marketplace is concerned, there is enough of participants to take care of the volumes of business that has been handled. I hope that answers the question.
Yeah. Got that. So just that. I mean, what I'm saying is the balancing act Gautam and team is going to do it. Like the people who are taking the bonds is like kind of they don't want to. I mean, the less hassle way, right? Of course, returns are low.
Correct.
But then
Correct.
people are saying, yeah, that's less hazard. I don't worry about. Now
It is
we are
right.
creating this platform where, see, in case of like some emergency, someone selling it is different story. But then this product is where it flourishes
So
only
funny.
when they trade.
So
Right?
funny, I'll tell you exactly how we are trying to avoid that. Because see, how Gautam is looking at positioning this, or liquid bonds is looking at positioning this, is why bonds would work better. What we will get into is how to use this particular asset class or this particular offering to various stages of our financial life. Right. So that is going to come up next because that's when, I will be asking Gautam and Pani to take a leave, and then we will be discussing this in the within the closed circuit.
Yeah. Thanks.
All right. So apart from taxation, we'll get to taxation. Okay, folks, since you all are here for such a long time, let me mention, as always, please understand, taxation is based on in one aspect and one aspect only. Are you receiving an income or are you making a capital gain? If you're making a capital gain, it will always be capital gains taxes or capital gains losses. If you're making an income, which is fixed, then you will be paying an income tax based on your tax slab. Very simple, right? What will be the tax is going to be on your tax slab. So if you're on the 35%, 40% tax bracket, whatever interest you're going to be making on this will be taxed as per your tax slab. Very simple. Is there anything that you'd like to add to that, Gautam?
Yeah, a couple of things. So so just to clarify, say you've invested a lakh of rupees into a coupon bearing bond at 10%. The coupon that you receive at 10% per year for the 3-year holding period, aggregating to 30% in total, will get taxed at your marginal tax slab rate, because that is, like Sharath mentioned, income that you have received. Now, if you do decide to exit the bond at any point of time in those 3 years, you would have already received, say you do it after a year, you receive 10% as interest during that interim period. That gets taxed as at your marginal rate. Now, when you exit the 100 rupee bond at either 102 or 98, it could be higher, it could be lower, it could be the same face value. Then any differential from the face value of the bond will get taxed as LTCG or STCG, or STCL or LTCL, depending on whether you exited at a premium or a loss. But that generally is a very small percentage, so it's not worth worrying about looking at from a taxation perspective. For all intents and purposes, investors should assume this gets taxed at your marginal rate. To add to your point of most salaried people will be in the 30, 35, close to 40% bracket. Where this compares is, obviously, it's not a product or an asset class which gives you a lower taxation rate. But when you compare to all the other options that you have, where you're parking your money for a 6-month, 12-month, 24-month horizon, almost all of them will have a similar taxation regime, right? So the way to look at it is in the category or in the peer set from a 1-year, 2-year investment horizon perspective, am I making or am I paying higher or lower tax, and what is my post-tax returns? So theoretically, not that this is my suggestion, say if you parked money historically in a 1-year FD for emergency purposes or for short-term parking, that also entails the same level of taxation. Now, on a pre-tax basis, if your return is 3, 4, 5% higher, on a post-tax basis, also your return will be 2.5 to 3.5% higher. So the way to compare it is not to an equity product where you can make a LTCG after 3, 4, 5 years, because there the minimum suggested holding period is at least 3 years, if not more.
Thank you. All right, Gautam, I think with that, we don't have any other questions. So this is where I'm going to have to politely ask you to take leave for the presentation. But thank you for giving us a very comprehensive walkthrough on the platform and an understanding of the bond space. I'm sure, we will have different we will have an engagement past this in terms of how we're going to make things work for us. I will be looking at your team's assistance to, with all the difference in terms of logistics, because that's not that I think is still getting ironed out. But nonetheless, I think in a couple of weeks, I think it's going to be as simple, because my audience is used to, okay, tell me where, here's the link, get the thing done. And it's not come to that stage just as yet, but hopefully in the next couple of weeks, things will get ironed out, and we'll look at making this as a pretty much the same kind of success that we had with Liquibonds. Thank you very much once again.
Thanks, Sharath, and thanks everyone for joining the call today.
Thank you, Sharath. Thank you, everyone.
All right.
Thank you.
Folks, we have not done yet. Now we're going to take another quick 5-10 minutes in terms of how to deploy this money. But before we get there, this is Sharath Mascarenhas. I am your financial help, which I'll reach out to as and when you'll need guidance around. Can you please turn your videos on so that it feels a more conversation and not a screen like a one-way delivery like what was happening with Gautam? Thank you, Funny.
Yeah. So I have one question which I thought of asking, but I didn't. Like, since how long they are there? I mean, they are into,
In the
they're doing
bond
this
space,
now. Yeah, I mean, this
so
liquid bonds thing.
so and the liquid bonds avatar has just been like you seen, they've got their license in
Oh, so July.
2025. July
Okay.
2025. So that's when they were legally as a framework. But what is important is not about the bond space money. What is important is the risk mitigation experience. They have been in this line of work of evaluating risk since the time that we were looking at liquid loans.
Yeah, I mean, liquid loans, they did a wonderful job. I mean, I don't,
Right.
because as compared to FinServe or someone else, right? So they did a good job. The
Right.
only part that I was saying is like I mean, I don't know, maybe they are working on a duality is where my first duality, I mean to say, see, the people who go for bonds are something that, okay, I mean, I've taken it once and then I look for only a maturity, right? That's when because I'm clear. Why
Let
should
me
I
add to
trade,
this.
right?
Let me add. See, funny for us as in mishmashes. Any one of you all who are having an association with me, how we looked at instruments is not because of why the instrument exists. It's the solution. It's what specific financial goal or what specific association can we handle. Okay. For all of us on this call, there are two ways that we can work with this. One, like how liquid law bonds is presenting this solution to us, which is what you can buy and look at investing in bonds. You can trade bonds. You can make gains from this depending on which is. That is not my preference for my audience. What we're looking at liquid bonds is because of the alternative that they're currently offering, which is they've got flexibility on the platform. The company is already investing in X amount of, they're looking at, they have a skin in the game. I'm looking at this as a replacement to our savings bank account. Very simply put. Do you remember at one point in time when liquid loans were still functioning, we had three options for our, we broke down our emergency fund corpus into three components. One, the money that would always be with FDs or with arbitrage funds. Second component would be with liquid loans. Third component would be with invoice discounting. That was the framework that we did.
Correct.
Why did we do it? Because in all these three instruments, the liquidity is whenever we want. We can pull out the money when we need. Therefore, from an emergency fund standpoint, before these instruments arise or before these options were available, we only had FDs or arbitrage funds. Arbitrage funds made better use case scenario than FDs because for the majority of us who are in the larger tax bracket, the tax rate would be deferred, which means we would pay the taxes only when we had to pay the money when we had to redeem the money. Okay. And for some people, convenience mattered more than returns and therefore they couldn't care less. However, now we're getting back to the same platform. For example, when you're talking about your entire emergency fund, let's say this corpus is, let's say 15 lakhs or 30 lakhs for that matter. We break this entire corpus into three components. First component, either in FDs or in arbitrage funds. Because tomorrow, if you need this money, you can pull out the money just then and there. It is not going to get affected. There is no lock-in or anything of that sort. Second component of the emergency fund, which is the second 1/3 portion, will be parked either in liquid loans, not in liquid loans, sorry, in lending, which is where our money is parked in the P2P space, and this money has no lock-in. However, the money will be coming to us return only in small components on a daily basis. Right? So this will be the last 1/3 portion. The second 1/3 portion is what we are going to be using liquid bonds for. Because the idea is to make 8% without having to break and see which FD, which bond are we going to be looking at, 12%, 13%, 14%. We're not looking at any of those. Because for us to overcome that specific requirement, we have other alternatives. We have alternatives like GHL, we have alternatives like Better Invest, which is giving us 15, 14%. Challenge in that is we have to wait for those opportunities to come our way. Now, let's say we've got to a situation where, okay, in the next 3 or 4 years, I'm looking at retiring. And therefore, for that corpus of money, what can I do which I don't want to park in already all of these existing instruments? Because let's understand GHL, Better Invest are non-regulated instrument. Liquid bonds is a regulated instrument. Lane is a regulated instrument. Then at that specific time, we will be looking at certain specific bonds that are giving double-digit return, but more important, these things are protected. So depending on the timeline, depending on the maturity value, depending on what kind of participation is there, we will get to that on a case-based scenario because at any given point in time, it is not going to be only 30 companies. Sometimes it could be 30 or 40, or it could be 20 companies also, depending on the issue size.
Right. Actually, that is where I was looking. Say here, and I would say the factor that is important is that liquidity, right? Whenever you want
That
to
is
exit
correct.
and whenever you want to, enter, there should be some bond, either, yeah,
Right.
something that they are offering or some other person is willing to sell. And then
Mhm.
whenever we want to get out, there will be a person to buy it, right?
That
Otherwise,
is
this
correct.
becomes like a stock, like a
That is
whichever
correct.
instrument you cannot, you're stuck, right? So that
Right.
liquidity factor is important. That is where I was saying how good this platform is known, or how many users are there in this platform, how active they are, right? If
I
people are
don't
not
really think
ready
that
to
should be a
share.
concern. I'll tell you why. I'll tell you why that should not be a concern, Funny. Again, going back to the liquid loans avatar, as a platform, what was this? What were they? What was their speciality? One, make sure that they are only getting good quality borrowers. Number one. Number two, they're balancing the act between lenders and borrowers.
Correct.
At any given point in time in a marketplace, will there be borrowers? Will there be need for borrowing capital? The
Borrowers
answer
for
is
sure
yes.
will be there. Yes.
Right? Now we have to figure out good lenders on the platform.
Mhm.
The lenders, they are only opening at a scale. See, as a company, for them also it is. See, today the reason why they could pivot and they could start a completely new company is purely because of with their engagement and their relationship they've had with their past distributors. None of the investors, none of the lenders have lost money, which is a very, very big thing for 6 years. Correct? And they got out the system only because of regulation. Therefore, before randomly just taking all the borrowers, apart from this 30, depending on how large an audience pool is there to lend, or rather in this case, invest in the bonds, they will start opening the platform available for these guys.
Right. I'm sorry, we're just looking in because maybe I hope it's not disturbing to others. What I'm saying is that you rightly built the important factor is the borrower, right? That's what makes
Yes,
the liquidity part. Of course, lender is
correct.
important. Now, in this market, let's say markets are flourishing, equity market is
Right,
flourishing, right? Why
right.
would anyone wants to buy bonds?
It is irrespective funny. By
Hmm.
the same logic, but if equity markets are flourishing, why will you have FDs in the bank?
No, no. Point here, what I'm saying is FDs are meant where, okay, I mean, my what to call safe haven, I'm keeping it, or I
No,
can
no,
get
no,
it
no.
anytime.
Funny, that is for you. That is for you or majority. A good number of people. I'm having, you will notice that we are going to try to reach out to families whose parents are looking at, for them, wealth creation, no wealth creation, the only instrument they know is FD,
Okay.
right?
So,
For that, so how you're being introduced to the product is like there are multiple alternatives. What vertical? So I'll use a name now. I'm sure you'll have heard, because you're listening to so much of fixed income audios, you would have definitely got ads coming from Vint, that bonds platform. This is a platform that just goes directly and it just talks, go online and do this by themselves. No, they will say that they're curating and things of that sort. But is there skin in the game? The answer is no. Has there been default? The answer is yes. So where I'm getting at with this is there is a humongous market for bonds. It is
okay.
as big as FDs. Only thing is investors are not aware of this.
Okay, got it.
Right? For investors to get aware, how is this being positioned? For my audience, it is not going to be positioned as a different alternative to equities. This is another alternative available in the fixed income space. And in the fixed income space, how we are going to be using it from a convenience, optimization, and ease of access is going to be replacement to your savings bank account.
Okay, got it.
We are not looking at this to beat. See, in all practical purposes, it is not going to be able to beat any of the fixed income instruments that we are currently using. Right? GHL is giving us 24% at the moment. Better Invest is giving, it started at 18%. Now it's come down to 15, 14%, depending on the tenure. And obviously, these things will come down. So the way how we are using these two different alternatives, again, this is mainly meant for money that we can afford to lose, which means we have 5, 7, 8 years maturity. We don't need this money. However, for money that we need instantly, on a case-to-case basis, I will tell you which bonds we will be looking at. But by and large, in general, if you're looking at using this, it will be to replace your money that is there in the savings bank account.
Okay,
Or
got it.
as one portion to your emergency fund. Just like what we're going to be using Lane for.
Yeah.
Did that make
Okay.
sense? Funny?
Yeah. Great.
Excellent.
Yeah, thanks.
Any other questions, ladies and gentlemen? I don't want to
Yeah.
harp on how we are going to be using it. It's a very simple one-liner, right? How we are going to get started and all, everything follows the same process. There will be an email telling you the pros and cons of it. And after that, if you're interested, then you will reply to it and then the logistics follows. But any specific questions on the working of the product?
Sharath, I have not related to working of the product, but something related to comparison between the arbitrage fund and
Good question.
the
Go
liquid
ahead.
bonds. So in arbitrage fund, we might get around 7% returns. Along with that, there'll be LTC.
No, so let's correct that, Zubin. There has been a time, long time back, there have been returns even at 9%. But usually when you have to look at arbitrage, you have to look at how volatile the stock markets are. Usually a good reference point could be 5% at the moment. But if the volatility is very, very heavy, right, you can see 6.5. However, that is going to come down starting this year because we know Nirmala Sitharaman has gone about increasing the STT taxes. Okay, so that is not going to bring down the volatility as such, but in terms of the returns, for all practical purposes, look at it 5%. If you're lucky, you'll get 6%. And if there is one-way movement of the market, then you'll probably get little less than 5%. But an average 5% is a good number. But please continue with the question.
Yeah, so I assumed it around 7%. So I was trying to compare post-tax returns. So it was not the big difference that I saw. If I go with 35% as a
I will answer this in two sections. Number one, if you're comparing this as an investment only option, which means I either can invest in arbitrage or I can invest in bonds. Between the two, which one makes sense? For a higher tax bracket, obviously investing in arbitrage makes all the sense in the world.
Yeah.
Is this making sense? Now, if I'm looking at what Sharath is proposing, which means all the money that is there in an emergency fund, have it distributed across the board. There have been times, like I said, arbitrage fund is less than 5% or 5% return. Now, when you compare a 5% return vis-a-vis a bond that is giving you, let's say 8, 9 or 10, post taxes, the bond makes better sense. Therefore, we are using the diversification aspect in your emergency fund for that specific goal alone.
Understood.
Now, on the liquid bonds platform, there are certain bonds that are giving 11, 12, 15% as well. It again depends on the amount of risk that we are taking. That is one segment that we are not going to be touching as our audience. But for the platform, if you're looking as a general investor, option that you can look 14, 15% as well. And therefore, why will you now look at arbitrage fund?
Correct.
Conversely, for our parents who are not making any fixed income right now, where is this money going in? In the FDs, or let's say small savings funds, or let's say chit funds, right? If that's the case, what ends up happening? Now, for me, arbitrage doesn't make sense because all the benefits of an arbitrage is out.
Yep.
Right? Then I should look at fixed income. Now I'll look at fixed income, which is giving me higher double-digit return. And obviously, whether it is regulated or not, that is very important because at that stage in life, I cannot afford to take any risk with my capital.
Yep.
Is this making sense, Zubin?
Yeah.
So again, for liquid bonds, for lending, we are looking at this instrument just as a better alternative to our money that is parked in our emergency fund, which at this point in time, best alternative for us would be an arbitrage fund.
Okay, understood.
Right? Excellent. What else?
And one last question. So what is the return that we would expect from the liquid bonds? 8.
8 is what we're looking at. Is that better than your savings bank account? Is that better than your FD? The answer is yes. So that's what we're looking at.
Okay, understood.
We can make higher, Zubin. See, like I said, case to case basis. For you, that doesn't apply at all because you do not have any short-term goals where you need to book your money. For example, let's say in the next 3 years, you're planning to buy a house. You or anybody on this call, there's a large outflow of money. And good amount of that money is parked in equities. Irrespective of where the market is, we will want to start pulling out some money and put that money in a debt instrument. That debt instrument is where we are going to be coming back to liquid bonds because it's regulated. Yeah. And I can pull out the money when I need. However, like we already know, if you pull out the money when if we pull out our money from our equity-based investments, we have to pay taxes. To avoid the taxes, if you already have the money, then it's a better option to. borrow, loan against mutual funds,
Yes.
right? So you pay smaller EMIs, right? The percentage is 10%, but your portfolio will keep growing at much larger amount depending on how much money we're pulling out for and your comfort with loans and so on and so forth.
Understood.
Right? Excellent. Any other questions, folks? Kavita is not on this call today. Others generally Kavita would ask quite a few questions. Any questions, folks? Okay. So with that said, I think we can call it a day for today. I will drop your. This will obviously follow up with an email in terms of the pros and cons. Yes, we've not shared the recordings for the past webinars that have happened. It's just because of the multitude of things that are currently happening at our end. And we'll have another product launch happening next Saturday and the Saturday after that as well. So brace yourself for a little more of Gyan sessions for some of us and some of us entertaining sessions. But yeah, possibly by April, we'll have about 4 new products coming in again. So with that said, enjoy your weekend, folks. I will talk to you when I talk to you next.
Yeah.
Have a lovely weekend.
Yeah.
Thank
See you,
you.
folks.
Thanks, Sharad.
Thanks, Sharad.
Take care now. Yeah, thanks. Bye-bye.
Thank you, Sharad.